Hello friends. Last week in my weekly video, we discussed the possibility of the markets pulling up higher, and after a lot of give and take and to and fro, the markets actually ended up in the green. This week, I'm going to pick up the threads where I left them up from, and we're going to discuss just how much strength the bulls have to pull the markets higher. I'm Vijay Bhambwani. I'm a trader since 1986, and in my videos, I'm trying to help out fellow traders make better informed decisions using our exclusive in-house statistical indicators, which are available nowhere else. Let's dive right in and check out the market roundup window. As you can see on your screen, what you can see is that the Nifty and the Bank Nifty gained almost equally, a little over 2.5%, and this was primarily because of the retreat in the US dollar index, the DXY. I've told you that a strong dollar is invariably a sign of weakness for emerging markets, including India. And when the dollar retreats, it's a good sunshine period for emerging markets. Now, gold and silver also retreated because risk appetite or risk on returned to the markets, and traders started buying financial assets instead of running to the safety of bullion. Crude oil was more or less there, whereas natural gas fell a whopping 10%. Now, this is good news because household inflation can come down if gas prices were to fall sustainably. Early days yet, but this was the prime reason I told you last week that the markets might attempt to pull higher, because energy prices retreated last week and the dollar was more or less steady. It wasn't showing any signs of undue strength. Now, the 10-year benchmark bond yield also retreated sharply to 7.44%, and that's a good thing. The only negative on the horizon that I see, a marginal negative on the horizon that I see, is the USD INR, the United States dollar versus the Indian rupee, which has risen a little over 0.25%, and we've seen basically the USD INR close at a lifetime high on a week-on-week basis. Bond yields retreating is a good sign, which is why the Bank Nifty received a lot of buying support, and the NSE market capitalization gained 2.35%. Do remember, I've told you if the NSE market cap falls over 4% for 4 to 5 weeks in a row, the probability of a bear market setting in is elevated significantly. Mercifully, the NSE market cap inched higher. Market-wide position limits, or MWPL, climbed a full 4.44% on the base, which is pretty normal till the third week of any derivative expiry. And what's even more basically positive for our emerging markets is that the US markets pulled up sharply higher. This is something that I discussed with you in the US market charts last week, and I'm going to take it up again. So let's bring up the chart of the Dow Jones Industrial Average on your screen here. Remember what I told you last week, that there was a long-legged doji marked with an arrow. Now, this long-legged doji basically showed that the open and closed was fairly close to each other in spite of a big decline intraday, which means last Friday, the previous Friday, the markets fell, but they clawed up towards the closing of the session, and the bulls were seen resisting any declines. Now, the Dow Jones Industrial Average has basically shown a huge positive bull candle on Friday. And what we can see is the markets attempting to go towards the 50-day moving average. Remember, the death cross is still in place. So this is a good, strong pullback rally. This is still not a trend reversal, mind you. And what we are seeing on the NASDAQ is a similar situation. The death cross remains in place, and we've seen a gain on 3 out of 4 sessions. And what we are seeing is the index attempting to go towards the 50-day moving average again. Remember, this is also an overall downtrend, and the rally is a bear market rally as of now. The S&P 500 has a similar chart pattern. We saw a long leg doji on the S&P last week. Here again, I marked it with an arrow. Remember, Monday was a holiday in the US market, so we had only 4 trading sessions. The S&P 500 has gained on 3 out of 4 trading sessions, and a similar death cross is still in place on the S&P 500. So here again, you're looking at a strong bear market rally. Friends, a word about why the US markets are likely to go up and why are they actually going up? Why are international markets going up? Remember, this is a quarter ending, and in every quarter ending, mutual funds worldwide are obliged. In India, securities law requires that mutual funds disclose their NAVs or net asset values at the end of every quarter in one regional and one national newspaper. So there is pump priming of prices by the fund houses towards the fag end of the quarter. Number one, this is mutual fund end buying. Number two, on 8th of November 2022, you have a midterm election coming up in America. Economic data will be massaged, will be scrubbed, and will be polished. Bad news will be delayed, and inflation will be curbed by falling oil prices and a steady or even a strong dollar. So this is one reason why you're seeing a very strong concerted buying coming in the Western markets, which is lifting all boats with it in the emerging market space. As far as I'm concerned, this is still a bear market rally, but a fairly strong one. In the charts that we are going to come in the future, I'm going to tell you how I feel that this rally does have some legs to it. Now for our in-house study, the MWPL, what you are seeing is a routine but steady rise in MWPL to 28.12%. Do remember the days of 35% that you've seen in the third week of November 2021 are gone. They haven't come back ever since. So the two Marshmallow traders who roll over their positions to the next trading session or maybe the next trading week or month are showing lower risk appetite. Now the weekly chart of the MWPL confirms what I just told you. We are heading into the expiry week, and so far it doesn't look like we are going to get any closer to 30% anytime soon. So even in this June expiry, the 30% MWPL level is evading us. Let's see the index and stock futures turnover. Remember, this is a cumulative sum total of 3 derivative series. So it's June, July, August. What we are seeing is that the index futures turnover has fallen on a week-on-week basis because traders have raised their risk appetite and gone for individual stock futures. Do note, individual stock futures have higher beta or higher volatility. And traders, like I told you earlier, have shown higher risk appetite, risk on effect, and therefore they've focused on individual stocks more than index futures. The same is borne out on the weekly chart, as you can see, with a 20-week look-back bias. That's 4.5-5 months of data. And the individual stock futures turnover is heading into the upper end of this 20-week range, whereas the index stock futures turnover data shows that we are heading towards the lower end. So risk appetite is returning. Now this is the first green flag for the internal Indian market. From the overseas market, you've already received green flags. Now the basis of the prompt month futures. What is basis? It's the premium or discount enjoyed by the future over spot. Why do we look at it? Because it tells us the risk appetite of two marshmallow traders who roll over their positions to the next trading session. Now, even though the Nifty basis fell into negative zone, inversion zone, it recovered quickly. And we are now seeing the basis of both the Nifty and the Bank Nifty in positive zone but falling. Now, this is routine. As you head towards expiry, on expiry day, hypothetically speaking, the basis is supposed to be zero. So futures and spot prices converge towards each other, and therefore the basis becomes zero. So what I do want to watch is prices going higher in the coming sessions with basis remaining positive, ideally even rising. If that happens, I think the bulls might just expand their footprint. Now here, the basis chart is on your screen on a weekly time frame with 20 weeks data being on display. What you are seeing is that on a week-on-week basis, the basis has been sliding in individual, the Bank Nifty for 3 consecutive sessions. Whereas the Nifty is concerned, it's more or less stable with a downward bias. Most of it is due to expiry since the last 3 weeks. But Friday closes have been positive, above zero. The risk appetite is undeniably down because what you are seeing maybe approximately 14 weeks ago when the basis peaked up, those kind of enthusiasm levels have not been seen yet. Now for the advanced decline ratio. Now this chart is actually showing signs of a little bit of optimism. So I would say it's somewhat of a green flag. Advanced decline ratio measures nothing but the number of shares gaining versus the number of shares falling. All right. It's been below 1, which means number of shares falling were always higher for a long period of time in this 20-day chart. And there were intermittent spikes. But like I told you on my social media accounts, my contact coordinates will come at the fag end of this video. You can please connect with me and update yourself. At the end of the day, I update a lot of these statistical charts. Very simple to understand, but highly profitable for you. So I've been telling you that these spikes at 4 and 5 times readings of the advanced decline ratio were unsustainable. But now we are slowly but surely turning the tide. And in the week gone by, we've seen 3 trading sessions where the advanced decline ratio has stayed above 1. If it stays above 1 in the coming few trading sessions, which means the one marshmallow traders, guys who square up their trades intraday itself, they don't carry forward their trades. The marshmallow theory video is in the hyperlink in the description below this video, as also in a pinned comment below this video itself. Now looking at the advanced decline ratio on a weekly chart on your screen with a look back bias of 20 weeks, what we are seeing is that the ratio is now in the upper end of this range, 20-week range, which is enthusiastic. Like I said, if the advanced decline ratio stays above 1 sustainably, the bulls are going to get another chance to push the markets higher. Now, coming to our in-house exclusive indicator, the impetus. This is something that you have learned to trust over 15 months, and this has not let us down. Last week, I warned you that the impetus was in the overbought zone and was likely to fall. And let me reiterate, let me brush up your memory. I said the impetus has to fall because it's overbought. If it falls when the market is rising, that means the upthrust will be weak. But if it falls while the market is falling, that means the downthrust will be weak. In any case, a V-shaped recovery and a fresh bull market would be ruled out of the equation. Precisely what happened. Now, the impetus chart has fallen. From a near overbought situation on the daily compression period, the impetus is heading towards a near oversold reading. What does that mean, you might ask me? Now, the impetus will have to bottom out and rise higher again. Probability shows that the Nifty and the Bank Nifty should be going higher. If the indices are going higher, accompanying the impetus, accompanied by the impetus daily chart, that means that there is sustainability in the upthrust. This is another small green flag for the bulls. So far, I've been sharing red flags with you, but hey, we are traders. We need to go with the flow. And when the markets are basically telling us to go long, we should also keep an open mind. The same impetus chart is on your screen on a weekly time frame and 20-week look back bias. You are seeing how the Nifty and the Bank Nifty impetus is nearing its 20-week lows. So from here onwards, there is nowhere to go but bottom out and then inch higher. If it is happening with rising prices, even better, because the rally will get more legs, stronger legs. Now, for the LWTD indicator, this is our latest in-house exclusive indicator. You're not getting anywhere else. Unfortunately, it's a little misunderstood. In spite of the fact that I've made a tutorial video on the LWTD, the hyperlink to which is in the description and in the pinned comment below, and it will appear as an end screen at the fag end of this video as well. The Nifty percentage gain loss line is indicated as a blue line, whereas the LWTD indicator is shown as a red line. Do note how for 4 out of 5 trading sessions last week, the LWTD stayed above zero. All right. Now, in spite of the fact that the LWTD was above zero, the Nifty did log some losses, but it pulled back towards the LWTD. This is what the function of the LWTD line, the red line, is. If you've seen, if you've studied rather, the concept of a chaotic attractor, if you're a smoker, if you smoke and there is no fan or any draft of wind coming in the room, you see that the puff of smoke actually rises up towards the ceiling and accumulates almost at the same place in the ceiling. This is the concept of the chaotic attractor, or for that matter, a lightning arrestor. In spite of the fact that the lightning arrestor at the tip is as sharp as a spear, lightning, when it falls out of the sky, finds the tip of that lightning arrestor and connects with it and receives an earthing, so that there is no loss to property or life from that lightning. The tip of the lightning arrestor is also a chaotic attractor. It basically attracts the energy of the lightning towards itself. The LWTD is our in-house chaotic attractor, and IBEX has spent a considerable amount of time, energy, resources. Yes, it costs money, because when you trade on an indicator, the losses are debited to learning experience. Back testing is fine, but real world testing of indicators in the market costs money, and those costs are losses in trading. So we've fine-tuned this indicator. It works just fine. The only thing is, since I've programmed this indicator, I know what it's all about, and there is an element of curse of knowledge, since you don't know what the formula of this indicator is, which for obvious reasons I cannot share with you. I happen to have a little more confidence in this indicator than some of my viewers have, but remain assured, I bet my own money on this. So the LWTD indicator is basically showing it staying above zero, which is another green flag for the bulls. This is the daily chart, therefore the outlook is purely for Monday. Coming to the weekly chart of the LWTD, the lift weight thrust drag indicator, the tutorial of this is also in the description and in a pinned comment. What you are seeing is huge moves on the Nifty percentage gain loss in the last 7 to 8 weeks. This was absolute bone crunching volatility, which I have been warning you on my social media accounts. And the Nifty bottomed out a fortnight ago. A week ago, it edged higher but remained in negative territory. On Friday, the Nifty has finally emerged into the positive, with the LWTD, which has also risen above zero. So, slowly but surely, the pieces of the jigsaw puzzle seem to be falling in place together for the bulls, which raises the probability. Remember, in trading, there is no guarantee. We are not playing on guarantees. We are only playing on probabilities. So the probability has gone again in favor of the bulls. Another small green flag here. Now I take you through the footprint of the four market participant types. I begin with the FIIs, who basically raised their individual stock futures long positions on a week-on-week basis, which is why the red arrow is pointing upwards, whereas their index net short positions have come down, which is why the blue arrow is pointing up. It's not anything else but the outlook of the FIIs. So both arrows are indicating that the FIIs suddenly seem to have taken a bullish outlook to Indian equity markets. Where DIIs are concerned, they've basically pressed shorts on individual stocks as well as the index futures. Why is that? Because they've been picking up deliveries in the spot segment. If you've seen, it's the FIIs who've been selling in cash and DIIs who've been buying in the delivery segment. They've been hedging themselves in the futures space. Prop traders. Now, this is very interesting for me because these are brokers' own trades. These guys are second best to insiders because they know who's buying, how much, what price, and in what quantity. So their market footprint is fairly reliable. Now, prop traders. Now, this is the only thing that is a slight cause of concern for me. Prop traders have reduced their individual stock and index futures net long positions. As a matter of fact, on the indices, they are short. So they seem to be very skeptical about the sustainability of the up move. Remember what I told you. Where the charts of the Dow, the Nasdaq, and the S&P 500 are concerned, the bear outlook indicated by the death cross remains in place. This is a very strong pullback rally. The markets are basically trying to go up towards the moving averages, which are still sloping down. This is something that the prop traders seem to be keeping in mind. Let's see now what the retail traders have done, because these guys have done all the heavy lifting after the middle of 2020 COVID-induced lockdowns. Retail has been pushing the markets higher. So where the indices are concerned, they've raised their index net long positions, as you can see on your chart, which is why there's a blue arrow there. But where individual stock futures are concerned, they are surprisingly booking profits. Their net long positions are actually coming down. So both the prop, who are very smart investors and traders, and retail, who have the largest long positions in sheer size, seem to be thinking together and cutting their net long positions. This is one minor concern that I have. Friends, our in-house indicators done. We now come to the bond market. By now, you are very familiar with my style of thinking, my work, that I assign a great deal of weightage to the bond market because it's the source of money for other asset classes. And if you're a banking stocks trader or even a bank Nifty trader, you will ignore bond signals at your own peril. What we are seeing on the daily chart of the 10-year Indian benchmark bond yield is that the yields have definitely come down on a week-on-week basis, which means the bond prices have gone up. Now, what happens when bond prices go up? The biggest investors in bonds are banks, both private and PSU. So when bond prices go up, there's a mark to market profit on their bond portfolios. There was a news item in one of the banking specific websites which says the banks have approached the RBI for some relief because they have suffered a huge amount of mark to market loss on their bond portfolios. Remember, when the yields are going up, that means bond prices have come down. That's why the yields have gone up. So they've sought relief, and once that news hit the mainstream media, we've seen bond prices stabilize and even go higher. The markets rewarded the bank Nifty by lifting it up. That is the correlation between the Indian 10-year benchmark bond yield and the bank Nifty, which is why I keep reminding my viewers, please do not ignore bond yields. And the other aspect of bond markets is that you now have the RBI Retail Direct GSEC website, standalone website, where you can buy and sell bonds directly from banks without paying any commission costs or any other charges. And the bonds that you're buying, the central government bonds that you're buying, are 100% government guaranteed against fixed deposits, which are guaranteed only to the extent of 5 lakh rupees per individual. Here you can put 500, 5,000, 50,000 crores and still get a total guarantee. Plus, the yields are 7% plus, whereas FDs are barely about to give you 5.5%, 6%, depending on whether you're an individual or a senior citizen. So there's been some relief to the banking space thanks to the easing bond yields. I'm keeping my ears to the ground. I'm watching whether the 7.25 or 7.30 threshold is violated, which I personally don't think will be violated. And even if it does, it could be more of a photo op than a sustained decline. But early days yet, I have an open mind. I continue to ladder bonds, which I have been advising even to my followers and social media family. Please continue your laddering process. Don't stop that. You are in a good place. And if the yields go up, you're even getting better and better yields as you ladder in the future. Friend, bond markets done. I now come to the US dollar index. Remember, I've told you, do not ignore the indications by the US dollar, because all emerging markets, including India happens to be import dependent. We are a net importer. So anything that we import becomes more expensive if the dollar is higher. That results in imported inflation. All right. Now, the US dollar fell on the dollar index rather fell on 3 out of 5 trading sessions last week, as the daily chart on your screen shows. However, the price remained above its 25-day exponential moving average, which is a proxy for 1 month's holding on cost. So even the short-term outlook still remains positive as long as the dollar index stays above the 103 round number. The weekly chart on your screen shows a long leg doji kind of a formation in the week prior. It was a bullish candle, but the open and close were fairly close to each other, which is what was indicating indecision. Last week, we saw a bearish red candle, not very big in size, but big enough to overshadow or overpower the prior week's bullish candle. So it appears to be like a bearish engulfing pattern, where the range of this red candle engulfs the previous week's candle completely. So we need to see what happens in terms of follow-on action. Are bulls coming to support the Dixie or the US dollar index and raise it up, or there's some more selling pressure likely? If there is a marginal fall, even a sizable fall in the US dollar index, it will be good for emerging markets, including India. Our stock markets will take it positively. The price, however, still remains above its 25-week exponential moving average, which is a proxy for 6-month holding on costs. So the medium term outlook still remains positive. Declines will just be corrections, not trend reversals. Too early to call it a trend reversal. So the dollar index does remain a cause for concern for emerging markets over a period of time. Now, last week, I advocated a range between 106.30 on the upside and 103 on the downside. In spite of all that volatility, the range held. In the coming days, I expect the range between 105.75 on the upside and 102.50 on the downside. Keep your ears to the ground and monitor the US dollar index very keenly, my friends. The dollar index done, I now come to the bank Nifty, which gained 2.70% on a week on week basis. Do remember that inflation was easing a little bit. I told you in my last week's video itself, the basis for any kind of a pullback rally was number one, oil and gas prices seem to have stabilized or even fallen a little bit. Metal prices are coming down, so raw material prices and WPI are likely to come down over a period of time. Food grain prices like wheat, etc., have started falling. Wheat has actually given up a little more than 30% of its gains, and therefore there is a likelihood that nerves are likely to be calmer. And since banking is very sensitive to inflation, the bank Nifty actually celebrated by rising 2.70%. It rose on 3 out of 5 trading sessions. And last week, I told you in the daily chart, which is on your screen, that the low made on 8th of March at 32,155 would be a litmus test for the bulls. Well, the bulls passed the litmus test. They defended this support and the bank Nifty rose. But before you bring out the bottle of champagne and pop it to have the bubbly, do note a couple of things. And the things are the death cross, which you can see on your screen, still remains in place. And we have not yet overcome even one previous significant peak. So what we are seeing is a pullback rally. It is still a pullback rally. I've marked a place where the bank Nifty a fortnight ago had opened with a gap down. The first and foremost objective of the bank Nifty would be to close this gap. All right. Now, this gap gets filled at 34,346 in the spot segment. Should this gap be overcome, after that you have the exponential moving average, which needs to be overcome. So there are resistances on the upside. There is no doubt that the kind of move that you saw in the overseas markets, the US markets on Friday night, will see enthusiasm coming in our markets also, at least in the early part of the week. But this is still not a full reversal from the weakness into a new bull market. Can it happen over the next few weeks? Yes, of course, anything can happen. I'm a trader. I change my view with the market trends. But as of now, the death cross still remains in place. And this is a very strong pullback rally at best. The price remains below its 25-day exponential moving average, which is a proxy for a month-long holding on cost of a bull. So the short-term outlook also remains a little under pressure. Going now to the weekly chart, what we are seeing is expectedly we saw a green candle because the bank Nifty, remember, has gained 2.70% on a week-on-week basis, but it remains below the long-term average, which is sloping downwards. So it's too early to call it a complete trend reversal and a bull market. In the week before last, this index was number 2 on the most volatile list that we make in-house in BSPL, Bhambwani Securities Private Limited. Last week, it fell 3 notches to number 5. And that's a good thing. It's not just because the volatility of the bank nifty fell, but it's also because volatility of individual stocks continued to rise. And lower volatility is always better for retail traders who can't handle extreme amounts of volatility. Last week, I advocated a range between 34,425 on the upside and 31,050, which held perfectly well. In spite of all that volatility and in spite of gap ups and gap downs, those levels held. In the coming week, I anticipate an estimated range between 35,300 on the upside and 31,950 on the downside. Now, do remember, due to overseas cues, there is a possibility that these levels may be violated in either direction. Do remember, statistical beta or pure price volatility on an intraday basis is over the moon. So expect very patchy, very sudden, and very sharp moves in prices, which is why you need to keep your stop losses in place and trade extremely carefully, possibly with lower exposure levels. Friends, the Nifty done. Bank Nifty done. I now take you to the Nifty 50. Rose 2.65% on a week-on-week basis, and it clocked gains on 4 out of 5 trading sessions last week. Here on the daily chart on your screen, just like the Bank Nifty, there was a panic low made on 8th March, and the low was at 15,671. Last week, I told you what worries me is that this low has been violated, and on the upside, when the Nifty does move on the upside, the 15,671 level will act as a hurdle. Guess what? Somewhat in that vicinity itself, the Nifty encountered resistance on Thursday and somewhat lesser on Friday, but the closing is somewhat there itself. Now, here again, I've marked an open gap which the Nifty left on the way down a fortnight ago. And the first priority for the Nifty, in case the bulls are to dominate the sentiment, is to close this gap. Where does this gap get closed? This gap closes at 16,173 in the spot segment. Now that is likely to be a tough call. It's not impossible, but it's not going to be a cakewalk. It's not a walk in the park either. So you must watch whether the Nifty is able to take this level out fairly easily. The other thing is that the death cross remains in place. Do remember that. And the lower tops and lower bottoms formation still remains in place unless we overcome the peak made in June, which is close to 16,900 odd levels. Unless we go above that, we haven't yet reversed the tide, which still remains overall weak. So this is a very strong bear market rally. It has some legs, no doubt about that, thanks to the pullback in the US markets, but the structure has not changed materially. Now, there's another mild green flag for you here. On your screen is a Nifty daily chart along with the RSI, 14-period RSI. What I am seeing is a positive divergence on the RSI because even though the Nifty made a lower low compared to its previous swing low, the RSI is making a higher low. Now, this in technical analysis is called positive divergence, and the implications are that prices tend to move higher if follow-up buying support emerges. So here is a mild, small green flag for the bulls, and do remember the Nifty still has to close that gap and get over its moving average, which is a month-long holding on cost of an average bull. And at higher levels, there will be the concept of overhead supply. Last week, I explained to you what overhead supply is. You're stuck in long positions at higher levels, you're frightened. Now, when the market starts to come towards your break-even point, you'll start, market is rising, you'll basically start to unwind your long positions which are stuck when your break-even point comes. So at every rally, there are people waiting in the wings, weak hands, frightened people who are waiting in the wings to offer resistance. That's what is likely to raise the volatility in the markets. Shifting now to the weekly chart of the Nifty, what we are seeing is in the week prior, there was a sizable red bearish candle which has been pierced by last week's bullish candle. It is a rough and ready. It's not a textbook example of a bullish piercing candle because the low is mildly higher than the previous body's open closing level. Sorry. So it's a very weak and a rough and ready non-textbook style piercing candle, which means the bulls are attempting to pierce into the domains of the bears. Will they succeed? Hey, that's a function of follow-up buying. First and foremost, you'll have to overcome the top of the prior red candle, which is more or less near the 16,000 mark. Now, that is not only a round figure, but like I said, overhead supply is something that the bulls will need to overcome. However, the RSI remains one green flag and the markets need to catch up with what's happened in the overnight US market. So Monday's opening at least is likely to be in favor of the bulls. But do remember, on the long-term weekly chart, the price remains below its long-term moving average and the moving average itself has started to taper down. So don't bring out the bottle of champagne yet. This is a strong bear market rally. It is not a trend reversal right now. It's early days yet. It might happen at a later date, but right now it's premature to call it an absolute hard bottom. In the week before last, this index was number 7 on the most volatile list that we maintain in-house. It rose one notch to go at number 8, which is a relief, not only because the Nifty's statistical beta eased, but because the individual stocks volatility rose faster than the Nifty. Challenge to you still remains. Last week, I advocated a range between 15,925 on the upside and 14,650 on the downside, which held perfectly well in spite of all that volatility and brutal moves in either direction. In the coming week, I anticipate an estimated range between 16,350 on the upside and 15,050 on the downside. Here again, chances of this range being overcome in either direction remain fairly bright. Why? Because beta or volatility is way above average. So anything goes. Prices are sporadic, they are knee-jerk, and traders' nerves are stretched. Maintain your stop losses, trade light, and stay connected with me. My contact coordinates come at the fag end of this video. Update yourself from with all the end of the day charts and stuff that I upload on my social media accounts. Friends, one more chart that I've added since last week, the percentage component of options and futures turnover in the entire market's F&O turnover. What you are seeing, last week I told you that traders have opted to get out of futures exposure and go into options. Remember, the entire MWPL is down. That is something you figured out by yourself at the beginning of this video. The entire MWPL is down. But within that universe of MWPL, we are now talking about percentage composition of the sum total. This is not an absolute number. It's a percentage of the total composition of the MWPL. On a week-on-week basis, both individual stock futures and index futures turnover as a component of the total has risen, which tells me that risk appetite from the retail segment has gone up a few notches, which is another mild, small green flag for the markets. So the possibility is that if follow-up buying comes in, the bulls are likely to have an upper hand in the coming days. Friends, indices and the new study done. I now come to the most popular segment of this video, wherein I give you 5 stocks that have gained the highest amount of impetus on a day-on-day basis, where you take small exposure, wait for large price moves to make your profit, and 5 stocks that have lost the most amount of impetus on a day-on-day basis, wherein you take big exposure, wait for small price moves. This helps scalpers. Why the difference? Because there are different types of traders with different mindsets, techniques, and strategies. So here goes the list. The high impetus gainers list is led by Ipca Labs at number 1, number 2 Maruti, number 3 Britannia, number 4 Divi's Labs, and number 5 Hind Unilever. So dominated by pharma and FMCG here. The impetus losers list is led by AU Bank at number 1, number 2 RBL, number 3 Apollo Tires, number 4 L&T Finance, number 5 India Bulls Housing Finance. Friends, the hierarchy of this list changes from day to day, hour to hour, which is why this list is valid only for Monday. Should you feel like being updated with this list from Tuesday to Friday, do join our Telegram channel. The contact coordinates come at the fag end of this video, also in the description below this video and in the pinned comment. You can also opt to be included in our free WhatsApp broadcast list. Contact coordinates follow as usual. Stay connected with me on social media, wherein I update you with a lot of cool stuff, easy to understand, but these studies will not be found anywhere else in the public domain. That's my word to you. Before I sign off from this video, my friends, a sincere request. Subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. Good, bad, or ugly, let me know what your feedback is on our work here. And help us to reach out to fellow like-minded smart traders and investors like yourselves by referring my video to your family and friends. I thank you for your patience in being with me in my video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Have a very, very profitable week ahead. Take care. Bye-bye.